Welcome to the Scholar Advising Podcast. In this Q&A episode, we're diving into 3 timely questions. 1, should you reinvest your company's profits or diversify into the market? Our second is holding too much cash in uncertain times costing you better opportunities? And third, how can you safely structure a private equity deal with friends? Plus, we'll wrap up with our term of the day, which this week is QCD, which is a tax smart strategy for charitable giving. So let's jump into it here. The first question that we're going to be dealing with is, my business partner and I have over $10 million in profit sitting in the company account. Should we invest these funds back into the business or diversify into the market? So a couple of things to unpack here when you're talking about company profits. And this is not uncommon that a business does well and the value of that cash account for the business starts to increase, which can always be a good thing, obviously, of profitable business being turned into cash. Where it becomes interesting is you're really dealing with what is known as a distribution ratio or a plowback ratio, which is not uncommon for small businesses or big businesses. Every company has to make this decision of, what do you have to do? What is the business's goals out into the future? So a lot of time we're spending a lot of time going over personal financial goals of how much you should be saving, how much you should be spending, how much you should be keeping in an emergency fund, all completely valid on the personal side. They're also extremely valid on the corporate side as well. For instance, if you are a large corporation and you go make $1 billion this year in profit, at the end of that year, you have to determine then how much of that gets sent out to shareholders as distributions, those dividends, and then how much of that is actually retained within the company to be used for liquidity, to be used for future capital expenditures, future investment, mergers, anything along those lines. So that decision stays the same. And that sounds like the decision that you're in now, of that amount is building up in the business. Now, what's interesting about this is that this does start to create some competitive aspect of your personal finance versus the business finance. What I mean by that is, you have $10 million sitting in there. If you really needed a few $1,000,000 in your personal finances right now, then having it sitting in the business account is not actually helping out too much for your own personal finances. That's why I don't really recommend taking that money and necessarily diversifying it into the market within the business account, unless there's some tax reason not to do so. That money really should be distributed out to the shareholders, in this case, you and your business partner, so that way you can personally use that money for your own personal financial goals and not have to have it tied up in a business account. So that's going to lead to some diversification benefits there, of you being able to get that money out of the business, for one, and also allows you to create a really nice separation between what you have on the personal side and what you need on the business side. Now, how much you need on the business side is an age-old question, but how much cash to hold. And there's a lot of literature on this on the academic side and even on the practical side. My dissertation was on cash holdings and that amount. So there's a lot of arguments back and forth that you can make for how much a business should keep in cash. There's the obvious amount of how much you need for short-term expenses. This is more of a current ratio type of analysis. How much do you need to pay your bills? And generally that's similar to a personal financial consideration. It's how complex your business needs are for cash and how volatile they are. So if your business is very stable when it comes to revenue and expenses, then you probably don't need as much in cash as a business that is extremely volatile and next month sales might drop to zero. In those cases, you would need more cash. Typically, what's seen in a larger business, and it sounds like probably the case here with the amount of profit that's just sitting in the bank account, is 1 year worth of current expenses. So current assets would be not full expenses, but to be very clear, current liabilities would be things due within the year. So the amount of short-term debt that you have, or the amount of interest that's going to be due, interest payments that are going to be due on any debt for the business, those would all be current liabilities. Accounts payable would be current liabilities. We'd stack all those together and you'd want at least that amount in cash. Now, some people stack on top of that and say, I'd like to have all of that in cash plus have a few months worth of business expenses stacked up, maybe 3 months of that. You hit payroll, you hit any unexpected expenses in there. That's what I would consider kind of the first layer of the amount of cash. And then on top of that, I would start thinking strategically about what your goals are for the business going forward. In other words, if you're expecting to make an acquisition or do some major capital improvements within the next couple of years, then that would dictate how much more cash you need to be keeping in the bank. But the fact that you're wondering whether or not you should diversify into the market makes me think that you probably don't have any big expenses out there because we'd be keeping those in cash. And that starts to push a little bit more toward the distribution side. If the business doesn't need it and doesn't need it so much so that you're willing to go invest it in long-term assets, then that money should be distributed out to the partners so that way it can be deployed for personal finance. A little history on that one of probably one of the more famous scenarios of this on the corporate side would have been the Apple situation. So if you go back in time to like mid 2010s or so, so iPhone would have been 2007 or so, and Apple really starts to take off. They're making cash hand over fist. I mean, tons of cash rolling into the business on the balance sheet. At a certain point, they have hundreds of billions of dollars sitting in cash on their balance sheet. So just more zeros for this situation that we're talking about. And what actually ended up happening is you had activist shareholders come in and start taking a side that said, we need you to start either spending this cash and investing it in something or give it to us. Now, the issue with that is Apple at that time was not paying a dividend. And a dividend is a very bittersweet moment for a company because if we go back to the very beginning of this conversation of saying a company has two options, they can either reinvest it back in themselves or they can give it out to shareholders. When you give the money out to the shareholders, the implicit signal there that you're giving is we don't have anything interesting to invest in the business right now, or we can't earn a really high return on this money. So because we can't earn a high return on this money, we have to give that out to our shareholders, and the shareholders can earn a better return than we can with their money. And that's a really tough decision to make as a company, especially something like Apple, where you're the innovator, right? You've come out, you just invented the iPhone, and now you're having to tell your shareholders that you don't have a really good next idea to invest all of this cash. So during that time, they tried a lot of things. This was the time of the iPad, right? You started to have the watch come out. There were all these different options that started to show up. Not that they weren't successful, they weren't big enough to actually deploy all the cash that they had. So with activist investors coming in, which probably is a story for another time, we started to see a lot of pressure on Apple to distribute. And that's what led Apple to repurchasing shares and actually paying a dividend because of this exact conversation that you're dealing with now of what to do with excess profit sitting in the company. So to kind of wrap that one up, because I know we went into a lot of different areas there, I think if you're at a point with that $10 million that you're saying, let's invest it in the market because we don't have anything else to do with it, then that's probably a good sign that that 10 million is too much in the company bank account and that you should distribute some of that. And then really take a hard look at how much cash is appropriate for your business and what does that look like from both a short-term spending and a more strategic longer-term spending needs for the company. All right, so let's go into question number 2 here. I keep a large portion of my wealth in cash because of market uncertainty. Am I missing out on bigger opportunities? So this is not uncommon, especially with what we're dealing with right now. The market was down 20% through April and has now bounced back. So it is not uncommon to be sitting in a situation where a lot of volatility we've experienced, a lot of turmoil in the market has caused a lot of people to pull money out of the market and to put that in cash, especially now with interest rates being reasonable at that 4 and 5% on money market. It makes cash more appealing to do so. But what inevitably happens, the market comes back and then it creates this really weird situation of now maybe there's more security in the direction of the market. And because of that, you start looking at situations saying, well, now I'm comfortable getting back into the market, but unfortunately, it's now up 20% more than it was when you pulled the money out. And this is a common situation that will continue to come back as volatility happens. Because why did the market go back up? Because there's certainty. Markets move down on uncertainty, on fear. So whenever there's uncertainty with the future, volatility increases. which typically pulls people out of the market. And if less people are buying and more people are selling, markets will drop. So in times of peak uncertainty or volatility, we do see a lot of people end up in cash and they miss the run up afterwards, the bull market that happens after that drop. So to more directly answer the question of, are you missing out on bigger opportunities? I think the answer here is that you could be in a situation where you're missing out on future opportunities, but we want to be careful of sequence of return risk. And what I mean by that is we want to be careful, and which is likely the feeling that you have now of, if I go put the money in the market's already increased. So is it going to fall tomorrow, the day after I buy? And that's a valid concern with the uncertainty of what's going forward. And there's ways to mitigate some of that, right? One of the ways that it's extremely common to mitigate that risk is dollar cost averaging. So to put dollar cost averaging in perspective, the idea for dollar cost averaging is if you have $1 million to deploy in cash, you have one option, which is tomorrow you just buy $1 million worth of that security or that fund or that allocation. And that would be completely fine. But what's the risk? You buy it tomorrow, the day after that, the market drops 20% and you just lost $200,000. That is everyone's fear when making a big purchase in the market. So if that's the case, how can we mitigate that risk of the market dropping the next day? Well, the way to mitigate that is to average in our buying points over time. So instead of placing $1 million trade tomorrow, maybe you place $100,000 trade tomorrow, and then another $100,000 a month later, then another $100,000 a month later. So that way, over 10 months, you've now averaged out the point at which you were buying into that fund or to that allocation. So the good thing about that is it does remove some of that sequence of return risk that the day that you buy, the market drops the next day. So there's a little bit of removing that risk of market timing to that. Now, the downside of dollar cost averaging is that on average, the market is positive. So the S&P 500, the US stock market has positive average returns, which means over the long term, anytime you buy is better than waiting to buy in the future. In other words, the phrase will come in that the best time to buy was yesterday, right? On a trending market that is positive, that is true. Now, I have seen situations which are not uncommon of saying you kind of hedge that with an overall PE ratio of the market, and the market's really expensive. So maybe that gives more credibility to dollar cost averaging in. When the market has a lower PE ratio, then maybe that gives more credibility to buying in bigger chunks. I think there's some credibility to that. But at the end of the day, I think the bigger factor would be how much cash do you actually need right now? So if you have an emergency fund or access to liquidity that is reasonable, and that's a comfortable amount of liquidity, then dollar cost averaging shouldn't be as big of a concern for you. And the same would go for just access to cash in general. So if you have $1 million to deploy, but you have another $1 million that you've been keeping in cash or short-term securities that you could easily liquidate, then dollar cost averaging that first million probably isn't that big of a concern. Right? Now, if that $1 million was the only $1 million that you had, and a 20% drop tomorrow would absolutely be devastating for your entire financial future, then that's a completely different story. First, you shouldn't be in that situation. You should have cash. We should take some of that $1 million and allocate that as cash that you're going to hold for a while. And then the rest of it, maybe it's $800,000 can be deployed. And I would deploy it slowly. Typically, the most risky time for your portfolio, if you're looking at a typical retirement portfolio, are those couple years right before and those couple years right after retirement. That's the danger zone. Because at that point, the day you retire, your portfolio has the longest time horizon that it's going to have to work. And you're also further away from Social Security or any of these other sources of income that help soften the blow to the portfolio each year from an earnings perspective. Now, if it's not a retirement portfolio and this is more longer term investments, whether it's family money that you've inherited or it's money that you plan for future generations to inherit, or this is a foundation type of scenario, then the use for dollar cost averaging is dropping, right? Because the time horizon for those types of investments are 100 years, could be even more. So if that's the scenario, one is investing $1 million today versus investing $1 million over the next 10 months for a portfolio that has a 30 to 40, 50-year trajectory on it. And the final question that you have in here is, and this is a good one, I've been looking forward to this one. We would like to start investing in private equity to limit the amount of upfront capital that we would need to invest. We want to buy into a private equity deal with our friends. How would we protect ourselves in this situation? So there are going to be two answers to this question. There's going to be the answer of, if you did this, how I think you should go about doing it. The other is that you shouldn't do this, right? For many reasons. One is, if we kind of unpack this question here, the first point that really sets up a red flag to me is to limit the amount of upfront capital that we would need to invest. If you are concerned about not being able to meet the capital requirements for a private equity deal, then it's probably not time for you to be investing in a private equity deal, or you need to build up more cash to go into private equity so that way you can diversify that out appropriately. So you usually can get into private equity deals depending on the structure of the fund, starting at 50,000. Generally, you can go up from there, but 100 is common. And then certain funds are going to require much more. But for smaller deals, 50 to 100,000 is going to be reasonable. So if you can't meet that capital requirement and you're trying to split that up amongst friends so that way you can make that investment, you're adding a lot of complexity here to what's going to equate to probably a small portion of your net worth, which I never like that combination. I never like to add complexity for a small section of your investments. And that's the wrong direction. If you're going to have any complexity, then it better be worth it, right? We want to make sure that it's a large part of the portfolio. So it's there. Now, that's not to say you should go and buy a bunch of private equity just so you build up the complexity, but it's to say that if you're in a situation where you're having difficult meeting the capital requirements for a private equity deal, then it's probably not worth bringing in attorneys and setting up any type of these different entities to make the investment in the first place. That's red flag number one for me in that scenario. The other scenario is that you want to buy in with your friends. That's just never a good idea, right? Very rarely does that turn out well. And typically I recommend getting even more into the legal protections of that. And we try to separate those as much as possible. But if you were to go into the situation, so let's say you hear that and you say, Stefan, that sounds great, but we're going to go ahead and we're going to buy into this private equity deal together with our friends to split it up, maybe for diversification reasons or for a reason that we don't know. Then one of the first things I would do is I would call an attorney on this one. We need to likely form some sort of entity that is going to separate your personal assets and your personal investments from this new entity that is investing together into the private equity fund. So what I mean by that is, let's say you were to open up an LLC and then you allocate $50,000 to this LLC and your friends allocate $50,000, and maybe you have multiple friends that are buying in and everyone's going to allocate $50,000. And then now you can go to meet the minimum $200,000 for this private equity investment between the four of you. So now it's not you personally making that investment. The LLC is making a $200,000 investment. Now, where I say this starts to get tricky is you need to start establishing what happens if there's a capital call. So a lot of people don't realize in some of these private equity deals or private investments is if they need more money and they call more capital, they're going to go to their investors and say, hey, the deals didn't work out. We actually need another $100,000 for this investment to work. So then they're going to push that $100,000 requirement to the LLC. And now all four of you are going to have to agree on whether or not you are going to be adding an additional $25,000 each to keep your investment in this deal or get diluted, usually is how it'll end up working out. So that's where you really want to make sure you have clear legal agreements with it and start to have an attorney recommendation. You start having attorney recommendations and CPA recommendations and financial recommendations, you're really stacking up fees here. And this goes back to, is the size of this investment worth the fees that you're bringing on? That's where it doesn't start to add up, right? You're going to have thousands of dollars in consulting fees in different areas for what to you is a $50,000 investment. So you're 10% in the hole before you even invest into this private equity deal. So there's a lot of considerations there that I'd want you to really think through before you make that investment. In fact, the easier way to do this, if you are set on investing with your friends in this deal and you can't meet the capital requirements, is to maybe go to the private equity fund and say, I can't meet the capital requirements, but we have 4 or 5 people that collectively we can go in. Now, whether they'll do that, we'll see. But essentially, you kind of bring friends to the table, let them deal with the paperwork. But from the private equity fund's perspective, you're also adding complexity for them. Right now, that's more K1s that they're having to send out, and there's more investors that they're having to deal with. So it may not be worth it to them to do that. But some considerations there that you can jump into that may help mitigate some of those risks that we had laid out there for you. Now, this week's rotating special segment is term of the day. So we're going to look at a complex financial concept and break it down into plain English. Today's term is QCD, one of the many, many financial acronyms that exist out there. And this ends up being a pretty good strategy for making charitable donations directly from your IRA, with some tax benefits there as well. So let's break this one down. A QCD, Qualified Charitable Distribution, is a way for you to be able to move money from your IRA directly to a charity. And because of that, you're not having to pay the tax on that distribution. It's usually not a term that comes up until we get to another financial acronym of an RMD, of required minimum distribution. So in your 70s, you have a required minimum distribution from the government that says, you promised us that in retirement, you were going to take distributions from your IRA and pay taxes on them. And they really want those taxes because those are going to be income tax brackets. So they're going to be at a higher bracket. A lot of people get into this trouble where they have too much tax deferred assets, and then they end up with these large required minimum distributions or these large RMDs out into the future. And one way to get rid of that would be, what if we just take the RMD that's required? Let's say the government says, based on all our calculations, your RMD this year is $150,000. So if you take that $150,000, you'll need to pay income tax now on that $150,000, which is not ideal, but at least you get to keep the money. If you're in a situation where you say, I don't need the $150,000, I already have a brokerage account, I have plenty of money there, and we're charitably inclined, we're wanting to give to charity anyways this year, you can divert your RMD over to QCDs, essentially that distribution. So that way you are no longer having to pay tax on that required minimum distribution that you're making for the year. So it makes it a little smoother. It avoids any of the tax efficiency issues of these required minimum distributions, because you're essentially, through your tax forms, diverting your required minimum distributions to charity. And as far as taxes goes, that distribution never happened. So a good way to making charitable donations, a good way to help drain the IRA a little bit, and also a great way to mitigate some of those risks associated with RMDs in your 70s. That's what we have for you this week. I'm looking forward to covering a new set of topics next week. Hey, this is Stefan Scheit. Thanks for tuning in to the Scholar Advising Podcast. If you have a question you'd like us to tackle in a future episode, just send us an email at podcast@scholarfinancialadvising.com. We'd love to hear from you. Until next time.
Scholar Advising is an independent, fee-only financial advisory firm focused on providing hourly financial advice. The information provided in this podcast is for general informational and educational purposes only, and is not intended to constitute financial, investment, or other professional advice. The opinions expressed are those of the hosts and guests and do not necessarily reflect the views of any affiliated organizations. Investing in financial markets involves risk, including the potential loss of principal. Past performance is not indicative of future results. Before making any investment decisions, you should consult with a qualified financial advisor who can assess your financial situation, objectives, and risk tolerance. Thanks for listening.